Hello there, I'm Ariana CP Hunter, real estate broker and financial expert. And today we're going to be talking about credit cards, debt management plans, and consolidation of credit cards. Well, people get confused all the time, and they think a debt management plan and a credit card consolidation is the same thing. So today we're going to clear that up. Let's start with the most common, which it will be consolidation of credit cards, meaning that pretty much, let's say you have 4 credit cards and you want to just get one loan and combine all of the debt from those 4 credit cards into one and pay off only one time per month. So this is an option for some people that may have still good credit or reasonable credit, so they could take up a new debt. Consider it like a new loan. It's a brand new debt. So you're going to gather all that money you owe, and now you're going to owe one bank and not 4 banks. The benefit of that is that, well, the benefit of this type of product is that you could leave those credit cards open. Let's say you will have a Discover, a Citibank, a Chase, a Wells Fargo. Everybody gets paid when you take the new loan. And so those credit cards remain open. And now if you had a balance of $2,000 in each, you have those $2,000 available in each of them, and you have a brand new loan. Let's say that you went with Citibank for your consolidation, and now you have one loan payment with Citibank, and you don't have to pay the other ones, but you still have credit available if you need it. And so, like I said, this is for someone who could afford to take on new debt, that the credit is reasonable enough, and that they make enough, and they let you have another lump sum. So let's say if it's 2, 4, 6, 8, say $8,000. Your credit have to be strong enough to be able to carry $8,000, and your income has to be strong enough to carry $8,000. Now, there's another product, which is a debt management plan. And this is no more than 4 to 5 years. They don't give you no more than that. You combine all the credit cards that participate, because not all of them do. And pretty much they lower the interest rate substantially depending upon your situation. Let's say you lost a job, you got sick, and so that will determine what interest rate you'll be receiving. So what happened in the down payment is very small. And like I said, you'll be done in 4 to 5 years. You'll be done. The downside to that is that those credit cards will be closed, and you will not have them available. Now, the banks want to get paid, so to them that is a good option. It's a win-win for both. A lot of people want to pay off their debt, and they don't even have the option of bankruptcy. So this is something that many people use and sometimes abuse because it's available. Many people use that. They know they could qualify for 5 years. They don't have credit for that period, and then they pay everything off at a lower interest rate. But that affects your credit because it will show close, especially if your credit cards are history is long. If the longer you have your credit cards, the better it is. For the length of time that you have it, it looks better in your credit. So you never want to close credit if you don't need to. You want to manage it. So it would depends where you are and what your plans are. Of course, if it is too stressful and you don't have no source of income, and well, that's the other side of the story. Before I go any further, you do have to have some kind of income to be in that plan, because they want to make sure you're able to pay them. So you cannot totally not have no income. You have to have some kind of income. Perhaps you don't work, but you have a relative, your spouse, help you financially, or you get monies monthly from if you are in a program that you might qualify. So that is the minimum they require you to have. If you have no income, a lot of people, when they call in, they say, well, I don't have any money, and they think that that will help them their case, but in fact it doesn't help you. You just have to be bad but not horrible. You don't wait until you get to that point, because a lot of people figure, well, if I cannot do a debt management plan, and a lot of working people use that plan, the program. It just makes it easier to make one payment per month, and they know that they're not going to be using their cards for those 4 or 5 years, and they know that they're going to take a hit in their credit. They're okay with that, but then you can start bill again once that's over. Is always better than a bankruptcy. And like I said, not everybody qualifies. That is something you have to consult with an attorney, and I'm sure you could find many videos on the subject, because most people think that they could just file bankruptcy, and unfortunately, not everybody qualifies. Some people think they're going to walk away and not pay back anything. It is pretty much the debt management plan. What people don't know is that this is the assessment that they do for you is the same assessment attorneys use to figure out if you're able to pay back your debt. So if you're able to qualify for a debt management plan, you're better off because you don't have to pay those attorney fees. Keep that in mind, that if you go to a bankruptcy, not only is it going to last longer in your credit, but you're going to have to incur the attorney fees. With a debt management plan, you don't have to do that. You just pay them back, and you're going to do one payment to the company that you selected to go and carry your debt management plan. The ones who carry the debt management plans are non-for-profits. They do profit, but they do help to guide you as best as possible. So it depends where you are. So not one solution fits all, because it depends what you want to do. And like I said, many people do go and have a consultation with an attorney to see if they qualify for a bankruptcy. When they find out fees, they come back to a debt management plan. And like I said, the best option is try to consolidate it. But ultimately, what I would advise you is not even to do any of those things. I would advise you to pay off. Either you go with the Ramsey method, the smallest to the largest, the smallest bill, so you can feel sense of accomplishment, or you go from the top with the highest interest down, whichever feels you could alternate too. Life is ever changing, and we cannot. We would love to stick to one plan, but that's not always the case. So I suggest try to pay off what you pick one card that you love and you like the interest the most. Use pay it, put money there, pay it off. Usually, try to pay more than the minimum, so you have the money available to you, and that's the one you're going to keep using. And the other ones, pretend that you close them, but you really don't close them. It's just psychologically. You could put them in the freezer and freeze them. You could do that so that it takes you a moment to get to them before you, if you really need them, they'll be there for you, but they'll be free in the freezer. And you could get to them if you need them. It gives you time to think. So paying them off individual, that's the best option. Every time that you make a move, either a consolidation or a debt management plan or bankruptcy, it costs money, more money. So talk to somebody who specializes in budgeting to see what best option will fit your needs and your goals. I hope this has helped you. I hope it has clarified. I'm going to try to put a little description in the bottom of this video so you could see the difference. And I hope this has helped you. Till next time.